So we've now been through all of the candlestick patterns, and in this lecture we're going to make some conclusions and talk about some of the things we've learnt. And we're also going to talk about some of the things that these tests haven't taught us. So after going through the results, I think we can come to a number of conclusions. First of all, I think we can say that the bearish candlestick patterns performed less well than the bullish candlestick patterns, especially in stocks. And this is what we would probably expect in the first place, because stocks have an overall tendency to go up over the longer term. So it's not surprising that the short selling strategies performed less well. Second, it's clear that there's a lot of subjectivity in the definitions of candlestick patterns, ranging from the definition of a trend to the length of the candle to the size of the body, etc. It seems that many of the popular candlestick patterns are actually quite rare signals, and that makes analysis of these patterns particularly difficult. Some of the patterns that require gaps, for example, gave barely any signals over 15 years of data on some instruments. Thirdly, I think we can make some fairly bold statements, which in my opinion challenge what most people think about traditional candlestick patterns. Some of the most popular candlestick patterns were found to be barely profitable, and some lost money. And even some of the best candlestick patterns gave us win rates that were not much better than a coin flip. And from what we have seen in these tests, the number one best performing candlestick was indeed the humble inverted hammer. In the past, the inverted hammer has occasionally been mistaken for a bearish signal because of the long upper shadow and the closing near the lows of the price range. However, we've shown that the inverted hammer is in fact a very bullish signal, and based on trade frequency and profit potential per trade, it was the best pattern that we tested. Lastly, I think we've also shown that there exist plenty of inherent differences between different futures markets and stocks, because we often received different results, such as in the three white soldiers pattern. And this means it's unwise to apply a one-size-fits-all approach to your trading. For instance, we found some evidence that stocks do not trend quite as smoothly as some futures products. So it would be more reasonable to apply different strategies to different securities. So let's take a look now at some conclusions that we can't draw from these tests. First of all, we can't say how these patterns might perform on different time frames. These tests have all been on daily data, so we don't know how well they will perform on intraday charts or weekly charts or monthly charts, etc. For all we know, these patterns might perform completely different on different time frames, and that's something we can look into later on. Secondly, we haven't included any money management rules or any other technical indicators which we could clearly combine to produce much different trading results. The goal was to take each candlestick pattern and test it to see its stripped down potential, free of any indicator or rules, and we've achieved that. So that means to say that the results we've come up with are not set in stone. They could easily be improved by combining other rules and analysis. And in a later lecture, I will do just that when I put the patterns into a complete trading strategy with money management and portfolio rules. Overall, most analysts will say that candlesticks are more of a tool for confirmation rather than tools to make straight trade decisions. And I think this analysis does back that up somewhat. Candlesticks are certainly handy, but most of the patterns are not going to make anybody rich on their own. Lastly, I'd like to say a few words about the limitations of backtesting and from using computer analysis. First of all, because of the subjective nature of these patterns, as we've discussed already, programming them into code is difficult. And in some cases, I think you'll probably agree that the computer doesn't always do a good job of finding the right patterns, even when they are properly defined. Often, the human eye is a much better judge of the strength of a candlestick pattern, and is much more able to spot them in the first place. Second, although we've done this analysis and we've shown how the patterns have performed over the past data, we cannot necessarily make any inferences about the future because of those results. Backtesting is a very useful tool, but it only shows us the past. Financial markets are always changing, so these patterns may perform completely different in the future than they have before. Although I do think that's unlikely that we will see any of the unprofitable candles become strong performers going forward, because as markets become more efficient, profitable patterns will get arbitraged away rather than them coming back into profit. So these are just some considerations and some comments about the analysis so far. We've been through the main part of the course now, and in the next section we're going to go over some more ideas about how to use candlestick patterns, whether or not you should combine them with other metrics, and the potential results from doing so.